Welcome. This is the Atram webinar series. We are about to start in a few minutes.
Almost everyone has at least one relationship with one financial institution. Practically all businesses, regardless of industry, require financial services at some point in time, be it credit cards, bank and time deposits, loans, insurance, or investments. But financials go beyond these. It evolves through technology, and rapid innovation has given birth to a long-term trend called fintech or financial technology. Fintech is a powerful trend. Electronic payments are steadily growing with a lot of room to grow exponentially. On top of this, we also have the rise of cryptocurrency and other blockchain technologies. With the Atram Global Financials Feeder Fund, investors can participate in growth of companies around the world that are involved with providing financial services. The fund gives you access and diversification to global financial names that we normally do not have locally. The fund also invests in fintech, which a normal financials fund would not. Invest in the biggest global companies in the financial industry. Participate in the global recovery. Diversify your investment portfolio by investing in this fund. Invest in the Atram Global Financials Feeder Fund. For more information, visit www.atram.com.ph.
Welcome. This is the Atram webinar series. We are about to start in a few minutes.
Do you want to make your money work for you but find investment intimidating? Do you want to build towards a better future? With Atram Group's funds, you can invest according to your interests and values. Investing is now made easier and affordable. Step into your future self, invest to reach your goals and aspirations. Matching your risk appetite and investment horizon has never been this easy. Let us help you maximize your earning potential by writing the growth story of the Philippine economy and opening your doors to the international trends in the global markets. Let us prepare you for a better financial future. At Atram, we're making lives better through investing.
Good afternoon, everyone. Welcome to the Atram webinar series. Today's webinar is on capitalizing on change, financial sector in a higher for longer world, featuring the Atram Global Financials Feeder Fund. I'm GP Chong, your host from the business development team of Atram, serving as your bridge to an afternoon filled with informative and insightful discussions on the evolving trends and technologies shaping the future of financial investments. In an era where digitalization is becoming a lifestyle rather than a trend, technological advancements are rapidly and constantly evolving. The ever-evolving landscape brings forth changes in many industries, particularly in finance, where markets are highly competitive and constantly seeking innovative solutions to stay ahead. One of the widely discussed emerging trends in financial innovation is the utilization of the machine learning algorithms to enhance and decision-making process. These technologies have the potential to revolutionize the finance industry by improving efficiency, accuracy, and risk management. To shed more light on the matter, our speaker for this afternoon will be sharing his research and expert insights on the influence of technology in the future landscape of financial investments and the opportunities in the global market. We hope by the end of this webinar, you will have gained a deeper understanding of the technological and financial sector and how this may influence you in your investing decisions and financial considerations. So sit back, relax, and get ready to learn. Before we officially start, please be advised that this webinar will be recorded and shared on all our social media platforms. You can go back anytime and anywhere at your convenience. Whether you are a beginner or a seasoned investor to the world of finance and investments, who wants to stay up to date with the latest investment news and strategies, we've got you covered. Our official YouTube channel, that's at Atram Studio, provides a wide range of videos covering the latest market updates, finance and investment topics, past webinars, and even Atram itself. Make sure to subscribe to our official channel and click on that notification bell so that you'll never miss an update when we release new content. You can also visit our website. That's www.atram.com.ph for a more comprehensive information on the market, finance, investments, and of course, all the funds that we provide. All of these can also be found on our official social media pages. So make sure to follow us by scanning that QR code flash on your screens right now. For a more active and engaging discussion, we highly encourage you all to share your burning questions, whatever questions, burning questions that you may have about today's topic. Please feel free to send them through that Q&A tab found on your screens. Our speaker for this afternoon holds a degree in economics with a focus on finance from Boston College. With over 15 years of experience in the financial services industry, he has worked extensively in global equity markets at Morgan Stanley across New York, London, and Hong Kong. Recently, he led the Asia product team at Morgan Stanley and was responsible for promoting and delivering global research content and innovative ideas. Prior to that, he held a senior position in the global equity sales team based in Hong Kong, where he engaged with sovereign wealth funds, asset managers, and hedge funds throughout Asia. Currently, he is the vice president within BlackRock's Fundamental Equities Group as a product strategist representing global thematic and core equity strategies, mainly responsible for delivering solutions from across the fundamental equity platform to clients in the region. Our dear audience, it is my pleasure to present to you all Mr. Brian Knowles. Hi, Brian. Good afternoon. Thank you very much for joining us for this afternoon in our webinar.
Yeah, thanks, JP. Just want to make sure you can hear me okay?
Yeah, we can hear you loud and clear, Brian.
Great. Thanks very much. And thank you very much for the Atram team, and very excited to be here with you guys today to give an overview of where things stand and what the outlook looks like for the financial sector. Thank you for the introduction and giving a bit about my background. I think a lot of what I cover now and used to cover really applies to the macroeconomic environment that we find ourselves in. And, I think if, especially the last couple of years in particular, it's been incredibly volatile, and not just for the financial sector, but for markets generally. And, that's not new news to anyone. We're all aware, I think by now, of some of the consternation that took place in the banking sector earlier this year around Silicon Valley Bank or Signature Bank. Then you had Silvergate, Credit Suisse, First Republic. There is clearly a lot going on in the space. But to give you a bit more perspective on the performance of the past year, what was pretty incredible is that last year was difficult for a multiple of sectors, and then that sort of changed, and we had a bit of mean reversion to start the year. And why I mentioned that is that financials were really no different. After having a difficult 2022, we had a very strong start to the year. In fact, World Financials was, as a group, one of the best performing funds within our BlackRock actively managed funds, and that compares to things like technology or really just, if I think about tech and everything that's happened in that sector, and you had financials right behind it, it was quite remarkable. And that it wasn't just limited to those sectors. There's some more thematic strategies or even other core strategies that we manage here. And so seeing financials off to such a strong start really gave some confidence that things were turning. And if you also think about that period, it was when recession was really a foregone conclusion as we started the year. Forecast went back to really starting in September and October that we would likely see a U.S. recession in the first quarter of last year. And when that didn't transpire, you saw economically sensitive sectors start to do well. And that included things like U.S. banks and European banks. And that was really up until March. And we all know what happened in March. And that's when we had this mini banking crisis with Silicon Valley Bank. And that led to a pretty nasty drawdown in the broader market. And that included financials. If I look at the MSCI ACWI Financials Index, that was down roughly 7%. Was down at that point 1.5% for the year, so giving back all of the returns and gains that it had made through the first couple of months. And that compared to the MSCI ACWI as a broad index, which was up 7% at that point, and that was being largely driven by, and still is, by mega cap tech and the Magnificent Seven that we read about every single day. Now, after that period, I think there was a lot of sort of gray clouds and gloom over the financial sector, and during that period, we actually saw some of that lost performance start to grind back, and we saw a lot of that um, lost ground really come back as financials realized that things had stabilized, and there's some reasons for that, and I'll talk about that because I think it's important to give the backdrop as it leads to where we are today. At that time, some of the biggest detractors were, probably no surprise, were Silicon Valley Bank, obviously, and Signature Bank, and that also had a bit of a ripple effect across some of the other regional banks across the industry. The bottom line for us back then and where we sit today is that while we didn't really anticipate things to move that quickly and the crisis to unfold as fast as it did, we did think that it wasn't really as a broad systemic issue as the media was reporting, and it seemed largely idiosyncratic. And in both situations, we saw U.S. and Swiss governments step in, which helped stabilize the banking sector and also the broader market. And I think it's important to note that the solution that was agreed to at that time, and that was between the Fed, the FDIC, U.S. Treasury, was really to backstop some of the concerns around the deposit runs. And that was more of an issue for what we were seeing in the U.S. Credit Suisse was a sort of separate example, but there was really few corporate or uninsured deposit-funded banks outside of the U.S., and that's really due to the stricter regulation that we've seen in Europe over the last decade. That's important because the European banking sector is actually one of the reasons why the broader MSCI ACWI Financials Index has performed so well after that crisis that took place in March. If I think about the S&P right now, this is the S&P 500, that's up about 10% year to date. ACWI is up about 6%. If we look at financials, it's up about 8% from those lows. U.S. banks and regional banks have given up some of those earlier gains we saw over the past 6 months, and they're about flat since that March period. And the European banks, which I just mentioned, sort of stood out, and that's because that group is up about 15% from the March lows and has really been carrying the performance of the broader index. And so that's where we are today. And I think, taking a step back and want to run through some of the slides that I have prepared for today's conversation. And that it's really around why we think the buy case for the financial sector continues to hold. And so if we go to the next slide, please. I think just to give a bit of a backdrop, this is a quick slide just giving you an overview or snapshot of what the financial industry kind of means versus the broader market. So you have a group that is 15% of MSCI ACWI. It's about 900 stocks. Over 20% of the MSCI World earnings is coming from financials. And if you think about the group, it also has both value and growth benefits. If you think about things like dividend yield or looking at off-benchmark growthier areas of finance like fintech, which I'm going to spend quite a bit of time talking about today. But importantly, there are really 5 key reasons that we like to highlight for why we think the buy case for financials remains strong and remains intact. And so if you go to the next slide, these are those 5 key reasons. So we have relative valuation, which has been the case for some time and still pretty compelling right now. Dividends, which are both attractive and we think secured. Interest rate beneficiaries, which is related to today's topic, given the backup in interest rates we've seen especially over the last couple of months, but really since the Fed embarked on one of the most severe and quickest tightening cycles that we've seen, in over 50 years. If we go back to the Volcker period, you have emerging markets, which is a big part of the growth story, and then finally, as I mentioned, fintech. And so if we go to the first one, just to hit on some of these for a moment, on the relative valuation side, just on the next slide. So the financial sector is one of the cheapest in the market and is still trading at an all-time record low relative valuation compared to MSCI ACWI. As of right now, it's roughly a 35% discount. It's still one of the, not only is it looks like it's one of the cheapest, it's actually the cheapest if you think about what's transpired with the energy sector over the last couple of months. So, this snapshot was taken as of the end of September and over the period of August, we've seen energy perform quite well as oil prices have marched higher. And so it's really, you're getting, pretty attractive valuations right now versus the broader market and on a relative basis versus a number of different sectors. We flip to the next slide. Now, dividend yields. This is incredibly important, I think, and it's something that, especially in a market right now where people are seeking out dividend and income, the financial sector really stands out here. So if you think about the group versus the broader market, it's pretty attractive. If you move then to the U.S. and especially Europe, Europe has a dividend yield that is roughly 3 times that of the market. Now, that's one part of the story, and the other part that I should mention that's not featured in the slide is that there's also buybacks which are taking place, and so the buybacks are a part of the broader total return strategy. And so, if you think about a company like UniCredit, which is one of the names that we've had in our have had in a portfolio, and find it continues to be pretty attractive, is that that has a dividend yield of around 6%. With buybacks included, you get it to a total return of about 10%. And so the picture of the total return story to shareholders is quite attractive for this group. Now, on the third slide, which is very topical today, we have interest rates. Now, this sector is historically one of the best positioned to benefit from a higher interest rate environment. As interest rates typically move higher, you do see financials do quite well. What's important is why those interest rates are moving higher. And so as I mentioned before, there's been a lot of concerns over a forthcoming recession. And so if there's a recession coming and you have interest rates going higher, that's not really the environment you want for the banking sector to work. And the point there is that there's really a question mark as to whether or not in the shape of the recession we'll see. If we see no recession or a more mild recession, then this group, which is trading at quite attractive valuations, really stands out. If growth were to stabilize, and growth in the U.S. actually has been tracking way ahead of expectations. We're going to get U.S. GDP tonight, and that should show that growth for the third quarter is somewhere between 4 and 5%, which is quite strong. And yet the financial sector hasn't really benefited from that, and that's really because of this broader concerns as to potentially where we are heading. So we'll see how that unfolds, but I think it provides a pretty interesting setup for us. The fourth reason. Just on emerging markets. On the next slide. So financials in emerging markets, this is not going to be any surprise to anyone here. We particularly see it across the region, but also areas like Latin America. Emerging markets are offering some of the fastest growth, given that so many customers are yet to be banked. And so those are one of the most underbanked markets that is available with huge growth prospects. And so we're pretty excited about the potentials for returns in emerging markets, and especially LATAM at this point. India also looks very attractive. China, at the moment, we find, given the issues around the property market and just broader concerns as to the direction of travel for the broader economy, we're less positive on China right now. But we're seeing and have quite a bit of excitement around is areas like Brazil. If we go to the fifth slide, which is on fintech, and that's something I touched on. So fintech is one of the areas that was especially hit hard last year, given that it has, we have financials and we have technology, and you get fintech, and anything with tech, unfortunately, was thrown out the bathwater last year as the Fed increased interest rates, and that weighed on some of your more duration-oriented assets and growth assets, and so that includes the fintech space. For this year, we saw performance that did bounce back with the broader financial sector, but it's had a few fits and starts. It's still an area that we are extremely positive on, given the growth prospects there. There's a fund that we do run, which is dedicated toward fintech, and we think that nothing has changed in the longer-term thesis. So that we're going through a bit of a digestion period as to how these companies are positioned, what do their balance sheets look like, and so while the growth prospects remain attractive, there's a bit of we're seeing a bit of a more choppy environment. The other thing to think about fintech is it's one of the areas that people should be looking for new entrants, not only just to enter and disrupt the market, but also from an IPO perspective. The IPO market has been more or less shut for the last couple of years, and as that reopens, you're going to see a number of companies that are pretty exciting with enormous growth opportunities coming to the market, and that's an area we're going to look to focus on future investments. So those are really the fundamental reasons for why we think that the financial sector is pretty compelling right now. One thing that I would add is, I spend a lot of time looking at positioning across the street, whether it's hedge funds or asset managers, and one thing that is pretty telling is that exposure to the financial sector does remain and has been relatively light for a lot of the reasons I mentioned. Most of our investors are crowded in defensive areas like healthcare or growthier parts of the market like mega cap tech. And so what has been left out is some of the more cyclical or even early cycle groups like financials. And so I think given you have this setup where the backdrop does look, it looks attractive with some headwinds that we need to clear, and yet positioning isn't there. So that offers another potential support. Now, as for the outlook, which is obviously key from here, and I talked a lot about some of the headwinds, but outside of those recent problem areas, not much has really changed in our conviction levels. We think that if between the U.S. and Europe right now, we think that European banks still remain very attractive. Valuations there, while they have re-rated, still are trading at roughly 8 times this year's earnings, and about the same for next year. As I said, like companies like UniCredit have a 6%. In some cases, some of the companies in European banks have an 8% dividend yield. Then you add buybacks on top of that, which there are plenty of happening within the European banking sector, and that's a pretty good total return story. As I mentioned, some of the issues that happened with Signature Bank or Silicon Valley Bank, and even Credit Suisse, we believe those to be more idiosyncratic. Credit Suisse being absorbed by UBS has created, actually, we think, a pretty attractive investment opportunity for UBS, and it's one that you'll see in many core portfolios within the financial sector. We also believe some of the litigation that is facing the U.S. is not really going to be as dramatic for Europe because they've already gone through that regulation cycle. And I think a great example is that some of the liquidity and capital provisions that were put in place have already that's already transpired in Europe. So they've already come out of this period where that might present some sort of overhang for the U.S. and especially the regional banks, which have assets under sort of 200 billion. If I think about the European banks, the other thing is that they still are forced to hold significant cash balances. At central banks, they have about $3 trillion that sits there. The cash savings rate in Europe is also much higher than it is in the US, which means that the European system, while it is facing a number of headwinds right now and seeing some signs of slowdown, it's still awash with liquidity. And from a financial perspective, just thinking about the European bank sector, is that this is one of the groups that's reported some of the best earnings and above consensus earnings throughout the year, and we still think that's going to continue. And that's really been driven from the shape of the yield curve as the ECB has tightened rates, and there have also been ECB has been raising rates while the U.S. is either pausing, which we saw recently, or at least slowing down those interest rate hikes. And so that's why the European banking sector, we think, has relatively done better this year. Now we'll see what the ECB does today. We'll have a decision out for them later, but our confidence is that rates are going to remain higher for longer, and that should translate to better net interest margins for the European banking group. Outside of Europe, some of the volatility we still think is presenting a number of opportunities to find attractive stocks within a variety of different groups. We're not just concentrating on buying large cap banks. We're looking at the asset managers. We're finding select opportunities in the insurers within fintech. And I think for the U.S., it's not to say just because there is this regulatory overhang, it's still going to take time for all of that to take place. One of the things it's worth touching on too is that we have just gotten through the third quarter earnings for the banks, and while the backdrop does remain quite fluid, we actually saw decent results, and mixed in some cases. If you saw some of the numbers reported by J.P. Morgan, which looked quite solid, you had Bank of America, Wells Fargo, Some of the regionals had decent results. Some of them did not. So it's been a mixed picture, but more or less, we think that it was in line with expectations and really not as bad as some had feared. But also note that some of the commentary coming from the banks was quite interesting. Citigroup was talking about how their pipelines, at least for on the banking side and capital market side, do remain pretty healthy, and those are growing. Their management team, the takeaway there was that they're sort of cautiously optimistic. They're seeing the same sort of cracks in the system that people have been concerned about all year round that really haven't eventuated. So some of their monitoring, but they keep reporting that the consumer is in relatively good shape, and you certainly see that with employment trends or retail trends in the U.S. I think about JP Morgan's CEO Jamie Dimon. He was talking about capital markets picking up as well. He mentioned that the consumer is resilient. He did mention that there are some headwinds that they're monitoring, but he's been sort of relatively cautious and always has been during those earnings calls if the hurricane is coming or there's reasons to be concerned. And so he doesn't want to send an overly positive message, but the takeaway from him was that things are in much better shape than previously feared if we were to rewind 12 months ago. If I had to highlight one thing that does stand out and will continue to stand out in earnings calls, it's really what's the impact of the CRE market or commercial real estate market in the U.S. And that's really a mixed picture in terms of exposures right there. There's some banks that do have outsized exposure that they're working through, and some of the large cap banks are seemingly in better shape than some of the smaller banks. But there's nothing that stood out to us as there's going to be an imminent crisis. And really, on the other thing I would say, just on the consumer, is that some of the things that they reported around the general stability and spend of the consumer. We saw this from Citibank. It was evident from Bank of America. We saw it from Wells Fargo. Yeah, American Express reported last week, similar type story. Even Visa was saying that they're not seeing any enormous cracks forming, and that the consumer remains in roughly the same sort of shape it did in a spending the same they were 6 months ago. And so it really be interesting to see how this all unfolds. On the regulation front, I think it's important to touch on this because it is something that comes up from time to time. But on a medium-term basis, we don't see an enormous amount of regulation coming in the short term. If after doing a post-mortem review of what happened with Silicon Valley Bank and what went wrong, what we saw is that all the regulators are coming together now and coming together with a number of different proposals, and the new rules won't be finalized until first quarter of next year. And assuming that all goes as planned, they won't start going into effect until the first quarter of 2025, and then you're going to see a gradual phase in, roughly a third from 2025 till 2027. So the banks have plenty of opportunity to get ahead of this and get their balance sheets in order where they need to. But the point is that this is going to take a while, and while it remain an overhang, it's not going to be to the detriment of some of how the banks are run. The other thing I would touch on that's important is that it's very likely that we did see the last interest rate hike from the Federal Reserve. They have a meeting coming up in the beginning of November. Expectations are that they're going to pause there. We'll need to see what happens with inflation and obviously the jobs market, but essentially what we've seen in terms of financial conditions tightening suggests that it's estimated that what we've seen in financial conditions tightening so far has roughly equated to about 3 hikes. And so what's happened over the last couple of weeks is that you've seen the Fed come out and actually talk about, sort of try to talk down interest rates in a way that they're not less hawkish than they had previously sounded back in early September. And so that's, I think, important as we think about the shape of the yield curve, which we think is going to still remain higher for longer, but we don't think it's going to overshoot much more from here. In terms of the shape of the interest rates and the shape of the yield curve, we think that, as I was saying before, is depending on why interest rates are going up, if it's driven by the broader economy, or is it because there's something more technical happening in terms of people or investors selling treasuries, or some of the auctions that are taking place are less well received. And so if it's going up because of the economy is strong, that's a positive thing that's not reflected in the valuations. And so as that narrative starts to come forward, I think that's it's why financials can start to do well again. As for our views on fintech, and then I'll wrap up and I'll pass it on to JP, but there's no change into our positive view. What we've seen with higher yields and how they've weighed on the fintech sector, that's certainly created some volatility, but valuations are extremely attractive in that group too. If I think about a group of fintech names, they trade around sort of 10 to 11 times next year's earnings, and that's versus a 5-year average of roughly 17 times. They also have a dividend yield that's about 1.5% right now, which is pretty interesting for a fintech group, which is typically seen as being growthier. And as where people should be looking at finding those sort of cyclical value companies we think make the most sense right now. And what do I really mean by that is that we look for names that have exposure to travel, so like Visa or MasterCard, or any companies that are undergoing cost-cutting measures to improve those balance sheets and free cash flow. And it's similar to what we saw with mega cap tech. Meta last year announced that this year is going to be the year of efficiency, and you saw Meta and other companies that were bringing down their costs and shoring up their balance sheets do extremely well. And that's happening within the fintech space too. To give us a bit more confidence that this disruption story continues, there's been a few like recent developments as I was going through some of my notes that I thought were worth sharing about all the disruption that's taking place. So, for like Visa, they've highlighted that travel trends remain robust. Cross-border travel still remains strong. They also haven't, as I said, seen a dramatic change in consumer behavior. They're announcing new initiatives too to expand how their fintech platform is reaching more customers. We're also seeing a broader and a broader expansion of the traditional banking space. A good example there is J.P. Morgan announced that it was opening a bank in Germany, and it was going to this is opening an online bank in Germany to service more customers, and that's going to be rolled out across broader Europe. And so that was new from them. Partnerships continue to be announced, which are quite interesting. Deutsche Bank announced recently an agreement with a company called Scalable Capital, which is on the private side. This is essentially a platform that's used for trading stocks and funds and crypto. Goldman recently announced a partnership with fintech companies like Wise on the payment side, and also Stripe. As for Wise, their recent results suggest that the growth in the TAM of the market that they're tackling is quite large, and they're having some success there. Another company you guys might be familiar with is Revolut. They're seeing a huge surge in user growth, and they've seen a big uptick in volumes. And the other thing to mention is just some of the less familiar and traditional platforms that even sit outside of traditional finance are doing some interesting things within fintech. And so I think about Apple's announcement earlier this year with their Apple Card savings account that allows users to deposit daily cash rewards with a high yield account of about 4%, just over 4%. Visa had launched a payment service with peer-to-peer apps, which is similar to what is happening with like what PayPal and how Venmo works. Twitter announced that they're doing adding some trading functionality to their platform. And Twitter, formerly known as Twitter, now known as X, but through their eToro partnership, I saw that WhatsApp has introduced a in-chat payments function for users that are operating, especially SMEs in Brazil. And even closer to home, for BlackRock, we've had a number of transformational announcements being announced recently, and it was something that was covered and is public on our from our earnings call. But we announced this deal with Monzo in the UK, which is allowing retail investors the ability to save and also invest in mutual funds in much smaller increments. And since launching or making the announcement, we've had 250,000 clients that have joined the waiting list just to sign up for this. We also announced this a deal which you may have seen in the region with Geo Finance, which is a 50-50 JV, and that's to help underbanked Indian citizens sign up for a platform where they can invest, and we're providing unique investment solutions to them. And so these are just a number of the, I think, exciting examples that's happened with the fintech space. And I think that list is going to continue to grow. And it's not just the new entrants and new players, it's really some of the incumbents and even lesser known companies. So I think it's a space to watch. And I think that fintech, as I highlighted in the very beginning, while it's a very growing and important part of the broader financials landscape. So with that, I know I've talked for long enough and covered quite a lot of ground. I'm looking forward to some Q&A, but let me hand it over to JP, and he can take it from here.
All right. Thank you very much for that, Brian, for those great insights, of course. And on the different innovative paradigms, technological advancements, and the evolving trends in the financial investments. Now, for this part of the segment of this webinar, let me explain to all of you, our viewers out there, and why you should invest on the financial space. And we have a product which what we call the Atram Global Financial Feeder Fund, and the potential and capabilities that it has to offer. So for our existing or prospective clients, for those who are new to the fund, so this one is a UITF. It's purely on equities. So if you have an aggressive risk profile for our peso earners, and when you go into the financial space, which again, Brian has dwelled into earlier, the past few minutes, and Brian was able to give us, in a way, an outlook and some justifications and reasons as to why the financial space is something that we should look into. The financial sector, it's something that we should add in our portfolio to diversify. So for this one, it's more on the long-term capital appreciation by investing on equities of the financial service companies. So next slide, please. Right. So just to explain further, so the Atram Global Financials Feeder Fund is a feeder fund which is the investor fund is here in the Philippines, but the target fund is BlackRock's World Financials Fund. So us as Filipino investors, our bridge for this one to invest directly to BlackRock is through Atram, which is the Atram Global Financial Feeder Fund, so that we can be directly invested to the BlackRock fund. So when we say why we believe now is the time for financial, this is being cohesive to what Brian has mentioned earlier, and he has discussed that, of course, the relative valuation, the dividend yields that we're experiencing right now, which I have a few examples later on the slides, the high interest rate environment that we're experiencing, the untapped PM potential. Brian has mentioned that there's exposures in Brazil. I think there is some in India, the UK, and etc. And of course, the technology innovation. Next slide, please. So in terms of, Brian has dwelled really into this slide earlier. So if we're going to type everything in a sense that if you invest on this fund, the diversity in the financial sector is you are covered in different types of economic scenarios or economic situations that the fund is invested on banks, life insurers, property and casualty insurance, consumer finance, the capital markets, financial technology, and of course, real estate. So there are certain market scenarios such as the rise in the GDP or the rise of interest rates, or is it a favorable or non-favorable market? You are well diversified. And if you move to the next slide, please. In terms of the stock market capitalization, it ranges from 30 to 50 shares, from small cap to large cap. And of course, the notable names right there, AIG, American International Group, HSBC, UBS. It also has exposure on UniCredit, which I guess Brian alluded to earlier, around 6%, and it's for a total return with a buyback to as high as 10%. So imagine that opportunities and possibilities that you can tap into on the long-term play for this one. Next slide, please. And as we show the historical performance of the target fund relative to the benchmark, this fund has been a consistent outperformer relative to the MSCI ACWI Financials Index, YTD, or this is as of September, or as of September of this year, it's around 16.56%. If you've invested last year, the historical returns is around 23%. It's because, again, Brian alluded to this earlier, that because of the exposure to the tech space, the tech industry, or the tech sector, it really helped the fund propel further. Especially those are the big winners of the last year or that industry. Next slide, please. And of course, I would just like to mention to our viewers out there that yes, it's tied to the interest rates, and we had the Black Swan event that happened around March of 2020, which was the COVID-19 pandemic. Just like to show that in this slide, I really attracted this slide, that the recovery to peak is in less than 2 years. It went down for in terms of the feeder fund level, Atrium Global Financial's feeder fund. It went down as low as around 63.073, but after around 19 months, it went to the peak of around 158. So for those who really went in during the global COVID-19 pandemic, where it was relatively cheap, and Brian's mentioned right now, especially in the financial sector, that due to the high interest rates, it's really relatively cheap for some stocks. For the who and it's when we started to recover as the years passed by from 2020 to 2021. The fund really recovered well. So with that, I just don't want to keep you all. And before we move to the next segment, and which is the important part of the segment, is the Q&A portion. We do want to spend more time on that one because we received actually lots of questions right now, and we want to tackle as much as possible all of them. So with that, it is with great pride to announce that Atrium has received multiple accolades this 2023. We were hailed as the best investment solutions provider by both the International Business Magazine Awards and World Business Outlook Awards. Atrium has also received the Most Innovative Fund Management Firm, Most Innovative Fund Offering Company, and Asset Management Company of the Year, which is highly commended from the Asset AAA Sustainable Investing Awards 2023 for institutional investor, ETF, and asset servicing providers. Just recently, Atrium won awards for the best asset manager from Citywar ASEAN Awards 2022 to 2023, and the best fund management company from the annual Global Economic Awards. These recognitions serve as a testament to our unwavering commitment in creating cutting-edge investment solutions. Our distinctive approach to managing assets and funds has been proven to help our clients in attaining their financial objectives. With a team of experts who constantly strive for excellence and innovation in the asset and fund management industry, we remain focused on pushing the boundaries of what can be achieved in the investment industry. We sincerely thank our clients and, of course, our partners for their ongoing confidence and support. Now, with that, I'd like to call back to the stage Brian for the exciting part of our afternoon, which is the question and answer portion. Actually, we already have a few questions here I can see from my screen. That's why I wanted to keep my segment as short, because we want to tackle as much questions as possible, or as many questions as possible. But we still do encourage everyone to send in more burning questions that you may have, and we will try to address all of them this afternoon. So with that, man, I'll just take a crack at it. The first question would be, it's addressed to you. Can you explain, Brian, on how interest rates affect different investments? And what can investors do to adjust their strategies because of these changes? I think this is a reference to the relationship between interest rates and other macroeconomic factors.
Yeah, thank you for the question. I guess there's a few ways that I think about this, from a broader market perspective and also within the financial sector. I think from a broader market perspective, as I was touching on before, it really depends on what are the reasons that are driving the shape of the yield curve and causing rates to move higher. So if it's the economy emerging out of recession, typically that's good for financials. And so you have the curve, which typically inverts, then you have the recession, and then you see a gradual steepening of that yield curve as we move out of the recession. And as growth picks up, that's typically a good backdrop for financials. And that's why financials are seen as being a beneficiary of early cycle environments. Typically in late cycle, you see other more defensive sectors outperform. And so those are areas like healthcare, even utilities, consumer staples. And what's interesting about this environment is that there's a lot of debate as to what kind of cycle that we are in. Did we have a recession already? We had a technical recession. There was 2 quarters of sort of negative GDP growth that came through, but we didn't have like a real proper recession that filtered and transpired and rippled across the U.S. economy. Similar for Europe. beginning of the year, the Eurozone had 2 negative quarters of GDP. It was very mild. And so, like, was that the recession? And, what kind of cycle environment are we in right now? I think that's going to continue to be a debate. And so there's no, I think, real answer that anyone has or knows for sure as to where we are. And that's why the markets can be a bit confounding at times. But I think what we do know is some of the key highlights that I pointed to before around valuations already being extremely cheap and pricing a pretty negative outcome. We know that the financial sector is a beneficiary of higher rates, and that typically should impact and in favor and be favorable for both banks, but also life insurers. Life insurers, that with the premiums that they're collecting from their policyholders, those are then invested and they earn a rate of return on them. So life insurers typically do well. If I think about the broader portfolio, though, it's rather than making a beta bet, we think that you really need to have an active approach and finding those idiosyncratic stories that have individual drivers behind their businesses. And so I was talking about UBS. We thought that the acquisition or merger between UBS and Credit Suisse was actually something that would be a beneficial and be a benefit to UBS. And so that's that was more of a catalyst to add a company like UBS to the portfolio. And it's not limited to any of the banks that did make acquisitions during that crisis period. It's what are some of the drivers that, irrespective of what's happening in the market, those stocks can do well. So I think the interest rate debate is going to continue. The only thing I would say too is that people are calling this the latest sort of taper tantrum, the latest backup in rates, similar to what we saw in 2013. And if you're liking it to a tantrum, what we do know about tantrums is that they're often very violent. They can be very violent, but they can be short-lived. And so I wouldn't try to make too many tactical changes within any of your allocations or across the broader market. I think it's finding something that you feel comfortable with and happy to hold for the next 12 and 18 months, and don't get whipsawed by some of the ever-changing environment and news flow that we see every day. And it's very easy to get pulled into that. It's really taking a big picture view and thinking about, okay, where are we heading? What's going to be the shape of the economy, which, in our view, if we do see a recession, it's going to be more of the mild variety. And therefore, financials look pretty attractive from that perspective, given the valuations that I mentioned and the capital return story and the growth aspects of areas like fintech.
All right. Thank you very much for that, Brian. Actually, I would just like to add on to it that, yes, agree on the cheap valuations right now, and you should really know, despite the ever-changing interest rate, and as you mentioned, is this a taper tantrum? When will we experience when would these interest rates would go down eventually? But as of the moment, nobody really knows. As long as you're comfortable on which holdings you are holding on to, and of course, your objective in the long run. And with that, I'll just go to the next question, which is a good transition, actually. So this one is addressed to me. For the Atram Global Financial Feeder Funds, what are the unique selling points that differentiate this fund from others in the market, and why should investors consider it? All right. So for this one, I will add on to our, I guess, in a way, reference of what Brian has just answered earlier. One is because the fund manager is BlackRock. BlackRock is well known globally on in terms of the fund management industry. They have like billions of dollars in terms of the fund management industry. Different types of teams, also across different asset classes. So in terms of experience as well, they have over like years of experience under their belt. And in terms of the fund, the specific fund, which is the BGF fund, BGF financial fund, that the fund is that the Atram Global Financial Feeder Fund is feeding off to, or the targeting, the selection in terms of the holdings. Brian has mentioned the UniCredit. Also, the story between the merger of UBS, where they were able to strategize and capitalize on it. And they were able to spot those growth winners in terms of looking for those idiosyncratic stories, and also looking for those the tech drivers in the fintech world. So with that, with all of the experience, the team in BlackRock, of course, that sets apart the Atram fund to other funds out there. All right. I'll now move on to the next question, and this one is an interesting question, actually, and this one is for Brian. Besides the good performance of banks in Europe, they're also pushing for regulatory advancements in the crypto space with introduction of markets in crypto assets regulation. Do you think that in the future, Europe will be the bigger market in crypto versus the US? So I think this is more alluding to the fintech space and comparing the geographical, I guess, exposures between Europe and the US in terms of crypto.
I still think it's still up in the air and up for debate as to who's going to emerge as the leader. I think every country is either quickly or each country is moving at a different pace as to their broader acceptance to the crypto space. And, I sit in Hong Kong. There's advertisements everywhere. There's crypto conferences being held. The same goes for Singapore. And so there's a lot happening within even the Asia region. If I think about what's happening in Europe, I think they have been one of the leaders in terms of the fintech sort of evolution and bring in new disruptive technologies to the market, like some of those that I mentioned as I was going through. Most of those are either private and in some cases public companies that are sitting in Europe. And so they've been at the forefront, I think, as to bringing on and supporting sort of the fintech development, because what they have realized from a regulatory perspective even is that, as long as the regulation is in place and things are set up in favor of the consumer, there's a huge opportunity there to reach millions of more people through leveraging technologies within fintech. Now, the US is also moving at a similar pace. Clearly, there's been a lot of issues in crypto around whether it's FTX and the trial with SBF, which I'm sure we've all been seeing the headlines around, is ongoing right now. What will emerge from that, though, I think, and is supportive, is a pretty healthy regulatory backdrop. And that may not be what sort of crypto users and investors want to see, but it's kind of what's really needed to give people a degree of confidence. There's been way too much volatility in the space, and it's kind of been likened to the wild, wild west. But there are some crypto firms that are out there that are more in the private space that recognize that there is a large opportunity if they bring in some regulation. So I was at a conference recently, and it was a crypto conference, and the entire theme of it was around regulation, and they invited regulators from Hong Kong to speak. And so there's a path forward. So I don't have a direct answer for is it going to be Europe or versus US. I still think it's largely up in the air, and it could very well come from APAC.
All right. Thanks for that, Brian. And so I'd like to move on to the next question while it's still hot. And you've mentioned in terms of the evolution, in terms of the financial tech space. Now, for this one is considering the evolving trends in the global financial markets. So this is more in the traditional financial markets. How can investors effectively balance risk and reward when diversifying their portfolios?
Yeah, to be honest, I mean, it's a great question. If I'm thinking about our fund specifically, it's one that is very diversified. I think that's one of the key selling points of buying a financials fund like the one we have. We also have a very experienced manager who's been in the industry and been an investment manager for close to 30 years. In terms of diversifying across different asset classes, it's like I'm not the best person to really ask for that. If I were to give you some views, though, I think diversification over time really does give you some stability in your portfolios. And JP, maybe Atram has some views around here and around diversification, but having some, you don't want to have all your eggs in one basket is the old mantra, and certainly believe that. Like, you don't want to have all your investments just in the technology sector. I think it's important to have more of a barbell type of approach, and that can be within the equity market, but it also helps to diversify, include other asset classes in that, because at any given point in time, there's going to be different drivers behind the market, and it's good to have that diversification within your portfolio.
All right. Yeah, actually, just to add on to that, Brian, yes, for us, quoting that very popular and very old quote that do not put your eggs in one basket. Yes, we do really champion in terms of diversifying the portfolios. You don't just put your eggs in just one sector, just purely tech or purely healthcare or purely, let's just say, purely fixed income or purely equities, as much as possible. The evolving trends in the financial markets, I guess, and if you will, is that you should have a diversified approach in things. For those who did not really believe on the tech space last year, but for now look at those who believed in the tech space, just a small allocation on that end, 10% of your portfolio. For some, for investment funds, like just the fund BlackRock has and Atram has. We usually, when we do our due diligence and when we have funds in our suite, it's usually, as much as possible, we want to make sure that it's well diversified, in a sense that in my slides earlier, this fund, it's around 30 to 50 shares, purely for those equity investors who really want to have alpha in their portfolio, and you want to diversify from a thematic theme, not only on your typical global equities, but a theme such as financials. With that, which brings me to the next question, which is a good transition actually. For this one, the question would be more or less, in the rapidly changing financial landscape. This question is addressed to me. How does this fund specifically, the Atram Global Financials Feeder Fund, adapt to capture global investment prospects? Can I reiterate the regions or industries it's particularly focused on? So one, let's take it on a step-by-step basis. I know I alluded to it earlier that it's well diversified. It's across the different industries, life insurers, banks, fintechs, REITs. Also, there are different types of insurances. In terms of the region, correct me, Brian, if I'm wrong. Yeah, we have exposures in the US, the UK, Brazil, India. So, and mostly on the EM markets, emerging markets. So that would be the growth of the fund, to drive the growth of the fund. Yeah.
No, that's right. I think one of the benefits of having an active strategy is finding those unique opportunities that arise within markets. So having an overweight to European banks is what has set apart the fund from some of our peers in the market versus the broader index, and has really paid off quite well. Of course, there's going to be some volatility, but it's really having that investment experience that our portfolio manager has, and finding those opportunities. And so taking down, so for instance, for this fund, having a lower weighting, while we still think that there's a huge growth opportunity for fintech, it's having a lower weighting right now, and that's really in the context of what's happening with interest rates, which is weighing on the broader group. And so when you see the broader fintech sector coming on a bit of pressure, it's affecting this investment less, and where it's offsetting that in a positive way on the other side of the barbell is European banks have been benefiting and have been outperforming. And even within fintech, it's finding those select companies, whether it's a payments company in Brazil, or something more of the cyclical beneficiary, like I mentioned Visa as a benefit from those tailwinds that are less related to what's happening with the yield curve at any given moment, but they have actual strong growth drivers behind it. So I think really having that active approach for the financial sector makes a ton of sense, rather than just buying a sort of passive investment, which also can do quite well, but you're not going to have a benefit from finding those interesting opportunities as they arise.
Yeah, agree on that, Brian. Interested. We had so much fun in the Q&A portion. We'll just take these last two questions. I'll just take a crack at it. Brian, this one is addressed to you. Is the market right now pricing out the rate cut for 2024 with what's happening to the US markets? Does this mean that the high interest rate environment will stay for the medium term?
Yeah, it's a great question. And unfortunately, I don't have a crystal ball, but we're seeing in the in terms of what the Fed futures markets have been pricing, is that it's moved around quite a bit. At one point, there were cuts priced in for this year, and then that's been pushed out to 2024. I've seen some banks on the street with forecasts for an interest rate cut to come as early as first quarter. Some believe it's going to happen in second quarter next year, and that's really what evolves with between the rate of inflation coming down near the Fed's inflation target of 2%. Also matters a lot is what the employment picture looks a lot like. And so that's what's driving some of those differing views between what's being priced into the market, and then also what's been priced in from a variety of different sort of sell side banks. And so even if you were to see a cut, it's the rapidity of those cuts. Then is it just going to be the one and then they wait? Is it going to be 1, 2, 3? Are they going to do it in a sequence? And that really depends on what's happening in the broader economy. So it's very well that we could see if inflation comes down closer to target, and if there's, say, stress in the system, you could see the Fed rapidly cut rates, but they may just want to cut rates gradually and see what the impact of that looks like. And so we could see an environment where interest rates remain higher for longer than they have been. If we go back the last decade, we've seen interest rates around 0%. So anything is higher than that threshold. So, they will be the higher. They may not be sort of 5.25, but somewhere 4.5 make a lot of sense. And that's still relatively high. But I think what you do need to see is just stability in the interest rate environment, and the market can still do well. Financials can do well, but even the broader market can do well as long as we see the volatility within interest rates stabilize.
All right. Thanks, Brother Brian. So for the last questions, just to us, so I can take a crack at it first, then you can answer after. Then you can wrap it up with any final words that you have for our audience. So for the last question, what new and exciting ways of investing and high-tech advancements are you particularly excited about? And how do you see them shaping in the future of finance? So I guess for me to take a crack at it is mostly um for especially closer to home here in the Philippines. Before the global pandemic way back in 2020, it was hard for us in terms of investments where you have to go to a very manual, that you have to go to a branch or a bank or any investment manager just for you to create a portfolio or add more to your portfolio. But due to the high-tech advancements or technological advancements is easy. Right now, you can just go to your phone, link your bank account, and again, just add to your portfolio or create a portfolio. And Brian has alluded to this earlier when other social media platforms out there such as X are tying up, having their own I guess financial investments platform, or partnering with certain companies out there, and even Meta. And how do I see them shaping the future? It's mostly us as investors or consumers. We are resilient, so maybe in a way it will shape us that it does not only adjust to our needs, our daily needs, our daily lives, but it will help us propel not only ourselves but also our portfolio. Brian?
Yeah, I mean, there's certainly a lot of exciting opportunities. I know we're over time, so maybe just to wrap up, I think altogether, covered a lot of ground. I think that the setup for financials still remains very attractive, given the things I touched on, like valuations, which have materially reset. Positioning, as I touched on, is very light toward the sector. I think sentiment, I would say it's bearish, if not more than neutral for sure. And there's still a number of compelling reasons to own the sector. And so if I think 12 to 18 months out from now, we have a few headwinds to work for, but I think given the starting point right now and the current valuation setup, it's a very attractive opportunity, especially with the capital return you're getting from the group.
All right. Once again, we'd like to extend our gratitude. Of course, we'd like to thank you, Brian, for providing us with great insights for this webinar. And of course, to you, our dear audience, for your active participation. Your questions were very interactive, engaging for us to imagine that we went a little bit over time. So we sincerely appreciate you taking the time to join us today. Atram Prime provides, thank you again, Brian. So Atram Prime provides access to a wide range of investment options, allowing you to customize your portfolio based on your goals and risk tolerance. With a commitment to a long-term growth, Atram Prime's expert fund managers employ proven investment strategies, guiding you towards building wealth that withstands the test of time. For more information, check out the video flash on your screens.
Good day. Atram is the leading independent asset and wealth management company in the Philippines. If you are interested in investing in Atram Prime, download the app in the Apple App Store or in Google Play Store. You can also visit prime.atram.com.ph to know about Atram Prime. If you have other questions, you may fill out the contact form on our website or send an email. We hope this helps. Thank you.
Whether you're a beginner or a seasoned investor to the world of finance and investments who wants to stay up to date with the latest investment news and strategies, we got you covered. Our YouTube channel, that's at Atram Studio, provides a wide range of videos covering the latest market updates, finance, and investment topics, and past webinars, and even Atram itself. Make sure to subscribe to our official YouTube channel and click on the notification bell so you'll never miss an update whenever we release new content. All of these can also be found on our official social media pages. Make sure to follow us by scanning that QR code flashed on your screens right now. Once again, thank you very much, everyone, for joining us this afternoon, and we hope to see you all in the next webinar. This has been your host. I'm JP Chong, wishing you and your loved ones continued health and safety. Have a great day ahead.